Good evening. This is Tommy Lackey of gtlackey.com and the Strength in Numbers report. I wanted to do a quick breadth video this weekend after the crazy week we saw in the range expansion to the downside and see exactly how much effect it had through each of the 6 major breadth charts that we follow. The first chart we always go to is the new high, new low differential. And as you can see, we saw some major expansion in the new lows this week. After toying with turning back positive last week and turning the moving averages back up a little bit, this week things just got hit hard as the markets rolled over. We can see the new lows skyrocketed up to over 380 on Friday. And then the new highs were only 3. That is a really dismal number. And what that did is that, in effect, took the 2 moving averages, the 10 SMA and the 30 SMA, and rolled them back over. We were already on sell signals here. All 3 of them were on a sell signal, so it should have been a huge surprise, but we did see a little improvement last week that got quickly thwarted. As we move over here to the advanced decline line chart, it really doesn't look much better. We see that it has been rolling over for a while. We had a divergence back in April, May, and then it's just been continuing to make new lows in a downtrend. We just didn't ever see price follow very much. We saw it continue to test this and back test this breakout zone. Well, the back test this week did not survive. People say after it hits a level so many times, the level weakens. Well, that's what we saw. Now, what we also have to notice on this chart, though, is up here, we're getting down to some levels that have been support before on the advanced decline line. So we'll have to see if we get any let up at this point. A glance at the moving average breadth chart shows that our final long-term indicator, which is the percent above the 200 simple moving average, percent of components above that, finally rolled over and went down below the 30% level, which is our lowest quadrant. The last time we saw that was back in October of last year, and then prior to that was in late 2011. So in looking at this particular chart, we see that this long-term indicator is now, all 3 of them have been having trouble and are now starting getting down towards levels that are showing some extreme. Now on this chart, we can then flip down to lower time levels, the percent above the 50 SMA and the percent above the 20 SMA, and we can see both of them are at pretty low levels, 17.5 for the 50 and down below 14 for the percent above the 20 SMA. All these are in the lower quadrant, so we could get buy signals off of these at any given time from here. The problem we see as we flip down here to the McClellan chart, which I've been posting more frequently recently, it is one of my favorite breadth indicators because it's a good intermediate measure. We see that we've had 3 failed signals now since we crossed below the 0 line. That's very rare. We don't see that very often. 1 or 2 maybe, and then a divergence. But 3 failed signals shows that this market really has been just sputtering along and moving sideways a little bit, and then finally it's just cracked on us. Well, with that crack on the intermediate, that doesn't give us much comfort for things to turn around right away or quickly, but then we have to drop down to the short term and realize that in order for this to crack, it started sending us down to extremes down here on the short term measures. The McClellan oscillator is now in extreme zone. We saw that last month, but prior to that, we didn't see it really with any moving into the extreme zone very far at all until last October or maybe January or December-ish. Okay, but other than that, it hadn't gotten down here too often in this sideways move so far this year. Now the breadth thrust indicator is very similar to the McClellan oscillator, but it is contained. It's made more into a ratio, and that allows me to compare it over many different markets to kind of see which is the most or least oversold. But as you can see here, it's at a pretty heavy oversold level, and actually it's at its most oversold level since back in 2012. Already surpassed the October lows on this particular indicator. And finally, we end with one of our shortest term indicators, which is the percent days. And we can see it's been pretty benign most of the summer and most of the year, actually. July had a little bit, but we haven't seen a tremendous amount of signals on this during this sideways action either. But we did get two back-to-back 80% down days. And typically when we see that, we should expect within 1 to 3 days a 3 to 5 day bounce or retracement that we can kind of gauge where things are, see if participants come back or if not. Obviously, if the weaker that bounces, the more chances that we have another flush and that things get uglier than they are now. But for now, we're seeing that the long term is pretty rough. It has rolled over and deteriorated a good bit, but the short term has now gotten to extremes that we have to be conscious of. And we have to look at it as a scenario that reversals can happen at any time. The question is where they go. So for scalps and short-term traders, this might look great. Anyone who's looking for more needs to have a little bit of a jaundiced eye on this until the buyers come back and really start proving themselves. Okay, well that does it for tonight's review of the macro breadth charts that we follow in the Strength in Numbers report. We also dig much deeper into sectors and some subsectors in the report, so if you'd like to take a look, please feel free to email me at gtlackey@gmail.com with your email and your StockTwits or Twitter handle, and I'll be happy to add you. Thanks for taking the time and have a great rest of the weekend.